On Friday, Brent crude fell around 2% to temper gains this month. Still, Brent is set for a third straight week of gains after a surprising surge in May, despite OPEC's production increase plan. In this next report, we decode how various bets are pegging oil prices higher, depending on various ifs and buts. Take a look.
From below, $63 a barrel. At the end of last month, Brent crude has surged to above $77 and counting. The recent tit-for-tat airstrikes between Israel and Iran pose risks to the new energy market landscape. However, Friday's moves suggest further fallout for global energy prices seems limited, at least for now. Markets usually tend not to price in geopolitical risks until a conflagration. They are currently showing little sign of factoring in a worst-case outcome. But for now, markets are bracing for volatility, with oil already carrying a geopolitical premium of about $10 a barrel since hostilities began last week. Citigroup says if Iran does shut the Strait of Hormuz, crude could spike to $90 and above. Almost 20% of the global oil supply flows through tense Gulf route. If Iran does decide to shut the supply route, bets are for crude to surge significantly higher. Separately, Jennifer McKeown, chief global economist at Capital Economics, said some extreme scenarios resulting from increased US involvement in the Israel-Iran war could push oil prices as high as $130 to $150 a barrel. That could be a reality, particularly if Iran retaliates in a major way. US intervention in the conflict would bolster that further, but exactly how much would depend on the nature of the involvement. The worst-case scenario risks, though, are an extreme bet. At the moment, with predictions broadly ranging from $75 to $95 for Brent if the conflict drags on. For markets, a breach above $100 will lead to panic among investors, although that looks like an unlikely scenario at the moment. At least based on the volatility seen in oil prices this week after the initial jump in the first 2 weeks of June. For China, the record oil stockpile offers buffer as the Iran crisis builds. Chinese oil refiners are not concerned about the prospect of disruptions to West Asia supply, despite the country being the biggest buyer of Iranian crude. However, a further jump in crude prices would cause further policy easing by major central banks. Even though central banks would like to think that the current price surge would have a temporary impact, it would be a brave central bank that would cut interest rates now. Definitely not after the mistake central banks made immediately after COVID. A surge in inflation from higher oil prices is the risk that central banks want to avoid, especially amid the uncertainty surrounding Trump's tariff policies. Business Bureau, WION, World is One, World.